Do not refinance your mortgage without taking into account the 5 things that we're going to discuss in today's video. So Josh, we often have people reaching out to us wanting to explore the idea of refinancing because they need cash out, because they want lower payments. Something has changed in their life from the time they originally got their loan, and they want to take advantage of a refinance in order to maybe solve the problem, make their situation a little bit better. So I thought we would spend some time today and actually talk about some of the problems you see with refinancing, what you hear from borrowers, the questions they ask, the things that they need to be aware of, and more importantly, the 5 things that they absolutely should avoid when going through the refinance process.
So specifically in this episode, we're going to be talking more about rate and term refinances, meaning I don't want cash out. I just want a lower monthly payment. If you've bought in the last 2 years, you got a 6.75 rate, you got a 7.25, rates drop down to 6, 5.5. You say, I want a lower interest rate. There are a million moving parts here and multiple ways to structure a loan, which that's good, right? You want flexibility, you want options, you want alternatives. The problem is the mortgage space, mortgage loan originators are a wasteland. Most of these people that do a lot of refinances, they either work for or came up through a call center, and it's about the pitch. How do you pitch it? How do you structure this to get as little resistance and get the customer most likely to say, yes, I want that. So when we go through this, I want you guys all to think in terms of none of these are a wrong way to structure it as long as it's presented to you side by side so you can see the options, the pros and cons, and what you are giving up. Because what's unique, Jeb, about a refinance, if I send someone a loan estimate or just an estimate up front of a couple of different loan options on a purchase, they look down and they go, cash to close. I am writing a check for that money. My money is coming in. When it's equity used to pay for the closing costs, it suddenly becomes monopoly money, and salespeople can talk people into doing all sorts of crazy things with their equity that may or may not be in their best interests.
Yeah, you mentioned a moment ago that it's a wasteland. It's like a boiler room. It's really what it is. It's, a big call center. How many of these can you churn a day? There's very little education on the other side, because quite frankly, they don't understand the process in most cases. They're just, doing what they're told to do. And, it's a sales tactic. It's trying to get, certain numbers, trying to hit certain metrics in order to get bonuses and so on and so forth. So the reality is most people out there probably shouldn't be refinancing at the moment, if we're being completely transparent. Now, that doesn't mean you shouldn't, because in some cases there are opportunities and things that change and you need to do what's right for you. One of those things, like Josh said, is cash out. Now, we're not going to dive into cash out, but we can touch on it briefly because I do think it's an important piece of the puzzle. But Josh, what are the biggest concerns, with refinancing? If we're doing the list of 5, let's start at number 1. What is number 1? The number 1 thing people should avoid?
The number 1 thing not to do is focus solely on the interest rate and lowering your monthly payment as much as possible. And if you're listening at home, you might say, this is the dumbest thing I've ever heard.
That's just exactly what I wanted to do.
Not to work on getting the lowest rate and saving the most money on my monthly payment. It's going to make more sense here in the short run. If you called the biggest retail lender in the country, you watched a Super Bowl ad and you saw the little missile blasting off and you said,
Josh, you're not on the Super
awesome.
Bowl. I didn't see your commercial.
I am not on the Super Bowl. So if you call on the Super Bowl ad, you are going to go to that giant call center full of sales tactics. And I can almost assure you the option that is going to be given to you is a great interest rate. It also comes along with a bunch of points and increasing your loan balance. No one ever says, hey, you know what I'd like? I'd like a bigger loan. They say I want a lower monthly payment. And the easiest way to manipulate that for a loan officer is to say, okay, I got this thing structured. We're going to save you, Jeb, you're going to be $375 a month of savings. That's awesome, right? We're ready to get going.
Absolutely.
Just gloss
Let's
over
do it.
Well, it's like, hey, I'm charging you 2 points for that. And they never stop and say, hey, I'm charging you 2 points. So you owe $500,000 on your house, Jeb. I'm going to take $10,000 of your equity and we're going to get you a savings of $375 a month. And we're going to go through the numbers here. I gave an example, did an example of someone that bought a $400,000 home. We're going to dive into this to bring it home so you can see these numbers. But If I say, hey, you can give me $10,000 of your equity and drop your payment $375, or you can keep all of your equity and drop your payment $325, it's a pretty easy decision for most people. There's a time and a place for paying those points and getting the absolute lowest interest rate, and we'll go through that. But you need to look at the entire picture. In a perfect world, you are going to come in, and the only thing we are changing is your interest rate. You walk out with the same loan amount, you walk out with a newer interest rate, you walk out with the same remaining term on the loan, and you just have a lower monthly payment.
Good stuff, Josh. So we're going to dive into those in just a minute. But before we do that, I'd like to take a minute and ask a favor. If you find any value in the content that Josh and I do here, all the time, effort, energy we put into this, guys, do us a favor and hit that thumbs up. And if you want to stay updated on the lives that we do, you want to stay updated on everything we do to educate the community, not only hit the subscribe button, but turn on the bell notification so that you can, see when we actually are here answering your questions live. So that shows us support, and we appreciate that. So Josh, points is number one, paying a bunch of fees. You kind of mentioned that. What would be tactic number two that we're trying to avoid if we're going through this process?
So the other thing that this is less of a call center, it's a subset of call center lenders. The lenders that bombard your mailbox. If you have an FHA or a VA loan and rates drop 0.25%, or it's been 200 days since you closed your loan, we're getting near that 210-day waiting period, you're going to get 1 million mailers in your mailbox. And one of their bullet points is you get to skip 2 payments. And this is 100% bullshit. There's no lender out there, your current lender nor the new lender, says, you know what, we'll have these loans that meet and overlap by a day, but we'll have a month or two where no one needs to get paid. Like, that's logical. You know that there's no one going, yes, we will have hundreds of thousands to millions of dollars loaned out to someone, but they can skip the payment. They can get back to us whenever they would like to. So in essence, what you are doing in that situation is you are financing a payment. So right. The entire payment. So look at it this way. Easiest way to look at it is that if we close on the 15th of the month, you paid your payment on the 1st, but that covered the prior month's interest. So you paid 30 days of interest for the prior month, 15 days is accrued, and we're paying that lender off. So at the end of the month, they're not getting a payment. They're not cool with not getting their 15 days of interest. They say, pay me the $385,000 you owe me and $1,452 of interest. And they'll break it down per day. This is what you owe us per day through the end of the month. The new lender, on the flip side, we close on the 15th. Well, on the 1st of the month, they've only accrued 15 days of interest. They are not set up to account for your little half payment. Someone has 2 days, someone has 22 days. So what they do is you prepay 15 days of interest. And then starting the next month, it's going to go forward 30 days, accrue interest, and you make your first full payment.
I just want to explain this in layman terms because I'm on the other side of it and I want to break it down real quick. When you make your mortgage payment, you're paying the interest in arrears. So you're always paying the interest from the previous month. Okay. So when you make, today is, we're in May. So let's just say June 1st. June 1st, you get your mortgage statement in the mail. Most people think, oh, I'm paying my payment for June. No, you're actually paying the interest from May. So that's the difference here in how this is set up. And when you buy a home, you're essentially, or refinancing, you're paying the interest through the end of that month. And then this is where Josh comes in and say, it looks like you're skipping a payment because your next payment's not actually due until the following month. Well, that's because you're paying the interest from the previous month. So Josh, how do they get away with this, is saying this? And I mean, again, I understood exactly what you were saying, but I think from a buyer perspective, a little more simpler is the way I understand it. But what are we talking about in detail here?
So again, in that example, you got 15 days to the old lender, you got 15 days to the new lender. There's 30 days of interest, no free ride. You're going to save the small amount of principal that would have been paid on either of those mortgages. But what we're doing when we're saying you're going to skip that payment, I'm not asking you to bring that money in. We're just going to add it to your loan. So you just grew your loan. We talked in step 1, don't go and pay 2 points to get a vanity interest rate by growing your loan when your goal is to get it paid off and lower your monthly payment. Same thing here. Cool, that sounded fun that we're going to skip a payment, but we didn't. We just grew your loan amount by that interest. And the most egregious one is many of these call centers say you can skip 2 payments. You say, well, how is that possible? Well, Jeb, we just talked about you made your first your payment there on May 1 and it covered April's interest. And now we're trying to close here on May 22nd. We got 22 days of interest. Well, what if you didn't make the payment on the first? You're late now. You have a penalty, but you're not truly 30 days late, a problem on your credit report till the end of the month. So they'll tell you, hold off. You're going to have a late payment, but you didn't make your May payment. We're going to close here on May 25th. You're not going to make a June payment. So we skipped May and June. Your first payment is in July. Well, cool. Did I skip 2 payments? Nope. I just added 2 months of interest to my monthly payment. So be aware of what this is. There are no free rides. You owe money on your house. You are going to pay interest. It's just, where is it going to go? And Jeb, we talked at the top of the show. Is this the wrong way to do it? Should you never do this? No, that's not the case. You might say, hey, you know what? I got a $2,800 tax bill that I have to pay, and I don't want to go into my savings to do it. So this interest is the lowest interest borrowing I can do. So it's a quasi cash out loan without really being cash out, because money to pay closing costs, interest, taxes, insurance, those aren't considered cash out. So is there a time and a place to do it? Yeah, but your mortgage advisor should be walking you through this and helping you understand what you are doing so that you can make the optimal decision for yourself and your family.
And Josh, along those same, notes there, and what you're mentioning is, if you're doing cash out, one of the easy things to calculate, and it's not really easy to calculate because some of the interest payments are different and whatever, but if you're pulling cash out of your home and your payment is going up in some cases, the easy way to do it is, what's the cost benefit analysis? How much is it costing you to do that loan versus how much are you saving? How long is it going to take to realize that gain? Now, in some cases, you're paying off high credit card interest. Sometimes you're paying off cars and whatever else. So the calculation is not always as simple as just doing that basic math. But the same can be said if you're not doing cash out. If you're paying points, in some cases, Josh mentioned not to do it, but you want a lower rate. You want that lower payment because you just going forward, you cannot do it. You don't care if it gets added to your balance or not. You have to have the lower monthly payment. Okay, understandable. That sometimes that happens. What is it going to cost you to get that? Amortize it over how long you think you're going to be in the house. Does it make sense to actually, can you do it? I mean, if you plan on selling your house in 3 to 4 months or a year, probably really not the time to do it. If you're going to be in the property for an extended period of time, like this is my forever home, I'm never leaving, then it may make more sense. But it's understanding these nuances, right? It's having the person to walk you through exactly what's going on versus trying to hide it, because that's what it is. It really is. It's either a lack of understanding on the side of the mortgage loan officer, which is sad, or them just not, having the chutzpah to actually explain to you what they're doing with the idea that maybe they're going to push you away if you actually knew what was going on. So I know we're throwing a lot at you, but it's important to do this stuff. Now, Josh, we talked about skipping payments. We talked about points. What about escrow accounts? What about impound accounts? Because impound accounts are a way, again, to kind of secretly hide what you're doing with financing some of these costs.
So in the current market, Jeb, with affordability strained, the average down payment, even among first-time buyers, is about 7 to 8% right now. But that means we've got a lot of people that are getting a gift from mom and dad, and they're doing 20 and 25% down. But most are doing that 3.5%, 5% down payment. As a result, they don't have the choice. They're going to be getting taxes and insurance impounded. So they have an impound set up. Now, if you've owned that home for 3, 4, 5 years and it's gone up 15%, now you've got 10, 20, 25% equity. It's a choice. Do I want to have that impound? I will go through and say at least 90% of my clients choose, for convenience sake, to have that impound. You are saving that money for such a short period of time that having it in your account, even in a high yield account at 5%, it's a small amount. It accrues over 6 to 12 months and gets paid out. Most people go, I don't want to deal with that. You guys save it in my impound account. So most of my borrowers have an impound with their current loan, and they want an impound with the new loan. unless we are taking you back to the same lender, the same servicer, which if you call the servicer, they'll do a refinance for you, rarely the best terms. But one of the benefits is a lot of times they will net out your impounds. It's a fancy way of saying, if I got $3,000 in my impound account and I owe $350,000, they say, you really owe us $347. We're going to keep your $3,000, but you don't owe us $350. We're going to reduce that. That's fantastic because now we can set it up on the new loan. It's netted out and you are not adding it into your loan. But again, a lot of these call center operations, they're not going back to the same servicer. As a broker, occasionally I look at it and I go, hey, we work with these guys and look, their terms are competitive. I can take it back there. We can net these out and do that as well. Or sometimes transfer them from one loan to the other. Either way, it's rarely a possibility, but it is sometimes possible. So what happens with the call center lenders, what they want to do is, hey, you don't want to come in. You remember you want to skip a payment. So I don't want to ask you for the balance in there. And a $400,000 loan, depending on how high property taxes are in your state and what time of the year, you might have $1,500 in there. You might have $6,500 in your impound account. So again, that's not considered cash out. A lot of times they're going to go, hey, I set it up for you so you get to skip 2 payments and then you got $5,200 in your impound account. We're going to add that amount to establish the new impound accounts, which is roughly the same, but actually a little bit more because we're going to have that 1 month where you don't make a payment. We got to put a little bit more into the impound account, but I'm going to just add that into your loan amount. So after we close in like 3 weeks, you're going to get a check from your current lender for $5,200. So we skipped 2 payments. We got $5,200 and you might say, hey, that's awesome. But between those two things, skipping 2 payments and the $5,200, we just added $11,000 to your loan amount. If you paid a couple points, we could have added another $8,000, $9,000. You can quickly end up on a rate and term refinance with a new loan that's $15,000 to $20,000 larger than your current loan. Which again, if you're aware of it, and the options and the alternative, and you are making the decision, yes, that cash is of value to me and getting it at 7%, 6%, 5%, whatever the rate is when you're refinancing, it's a valid choice and a decision. It's just not being presented to most people so that they can make that educated choice.
No, absolutely, Josh. I've had clients, believe it or not, tell me, hey, I'm never going to pay off my mortgage. And when I'm gone, it's going to be my kid's problem to deal with. I don't care what happens to this loan. Right? I'll buy a property on lease land. I'll refinance and add the cost back to it. It's their deal. If you're aware of it, you're okay with it, by all means, do whatever floats your boat. But the important thing is understanding most people's goal should be at some point to pay off the mortgage, right? I mean, that's one of the benefits of home ownership is fixing that housing cost and being able to pay it off within that term, 30 years or whatever. We're going to talk about how that's actually doable here in a minute, but you're going to pay off that term in 30 years and not have a mortgage anymore. If that's not the goal and you plan to have a mortgage forever, you don't care what happens to the equity, then by all means, add all of these things in and you're going to be good to go. But Josh, the biggest problem we see, this is probably the biggest problem, in my opinion, because most people just don't understand it. And that is always going back into a 30-year fixed mortgage. And you might say, what other option is there? I want a 30-year fixed mortgage. Well, talk about how that's presented from the mortgage side and how that actually sets you up for never paying off your home.
Historically, we've always had 30-year mortgages. Most people are aware of 15-year mortgages. The vast majority, 90, 95% of lenders will also let you do a 20-year, a 15-year, a 10-year. So we can customize down to that 5-year block. Well, somewhere as the technology continues getting better, lenders have gone down to the point where 90% of them will allow you to customize your loan term down to the month. So the example that we're going to use here is someone buying in March of 2023 when rates were up 7%-ish. And if we go forward next year to middle of 2025, which is what current projections are when we're going to see possibly a refinance market as rates drop. But if we look at that 2-year time frame, it's 24, 25 months. Well, we can actually customize that term. A 360-month, 30-year loan less 25 payments is 335. We can put you into a 335-month loan. And the reason why most people don't do this, most loan officers don't do this or even make their customers aware of the option, is it's a higher payment. It's not significantly higher, but every little bit you take off of the loan term mitigates that huge number that I get to say, Jeb, I'm saving you $472 a month. This doesn't sound as good if I say I'm saving you $451 a month. But when we pencil it out and we look over the next 20 years, it makes a big, big difference. So a lot of what we're talking about today, Jeb, requires some foresight, some thought, and some planning of where you're going to be, and also what the market is going to do. And that's going to be really, really difficult. We can look back the last 40 years. We talk about this all the time, a 40-year bull market. Interest rates didn't go straight down for 40 years. We had 2-3-year periods where they were higher and rising, but every 3, 4, 5 years, we had a refinance market. So when you look back, you say, never pay points. Keep shortening your loan term because you'll keep getting able to roll that rate down and shorten the term and get this thing paid off faster. I had people that went from a 30 to a 25 to a 20 to a 15. And as rates were going down, down, down through the late 90s and early 2000s, some of those people never had their payment go higher. They just got to shorten the term. So all of these are valid options, but you have to do some thinking about where you're at. I mean, if you're a newlywed, you're buying a 2-bedroom condo for the two of you, and your plan is to have 2 kids, probably 7-8 years from now, you're not going to be living in that condo. But we don't have any certainty. We don't know that to be the case. Tenure in homes is now 11 and a half years. So when you look at that, most people are in their homes a long time. And if we don't have that volatility in interest rates, rates don't have to go straight down, but they have to go high to low, high to low, high to low, where there's these dips that you get a chance to take advantage of. But really, I had people, Jeb, we looked at rates had kind of bottomed out after the Great Recession around 2014. We had the taper tantrum, rates popped up, and then we were in a pretty narrow range. And then it kind of spiked in 2018, which leads us right up to COVID. Well, we know what happened in COVID. In 2019, they were getting better. 2020 dropped. 2021, even lower. I had people come to me, Jeb, that had bought in 2014, 2015, 2016. Well, in 2019, when rates dropped before COVID, they did a new 30-year loan. They come back in 2020, hey, rates are even lower. They do another 30-year loan. And then values shoot up and they come back in 2022, early 2022, they say, hey, I got a bunch of equity in my house. We don't want to move. We want to redo our kitchen and add a pool. So they do another loan and now it's bigger and we start back at 30 years. When if we had been planning, we could have been just keeping that payoff date. So again, it's not up to me to decide what is right for you. It is up to me to present all of the options to you so you can make an optimal decision. We get all the time on inquiries from the show, Jeb, what's most important to you about your home purchase or financing a loan? Getting the absolute lowest interest rate. Getting the absolute lowest interest rate. This area right here is where you can be easily manipulated because there's so many moving parts here that truly the cheapest loan, if you went to the cheapest provider that has the lowest points for the lowest interest rate, lowest fees, but they put you in the wrong loan, structure the wrong length, the wrong skipping payments, adding the points in, you can end up far worse off than going to a lender who has good terms that helps you optimally structure for yourself and your future. So refinances, I say, be very, very careful of just going with whatever is out there as the lowest quote, because those providers, anytime a refinance boom pops up, we see these shops that pop up. That's all they do. They got 10, 20, 30 guys and they're buying as many leads online. And oftentimes they do really have very attractive interest rates, but they don't have any advisors in that call center that's going to help you guide you through all this to structure optimally for you and your financial future.
No, and the one exception I would say to going back into the 30-year term is if you know you're going to sell the house. If you know it's not going to turn into a rental someday, you know you're not going to keep that piece of real estate, take the savings. And maybe that additional savings you can use and put it somewhere and create something from it, right? I mean, put it in a high interest savings account, buy copper with it. I mean, that seems like a good investment at the moment based on where prices were.
GameStop.
But you needed to buy it a while ago. But anyway, so there's always exceptions to the rule. It's just understanding the rule before you make the decision. Now, there's two things, Josh, I want to do. The first thing is I want to go over the numbers that you talked about just a minute before we actually talk about the last thing to avoid. And the second thing I want you guys to do before we go over those numbers is if you are going through the process, you're getting a quote, you need a second opinion, just want to talk to an advisor, a professional, reach out. There's a referral link in the bottom of this video, in the description of this video. where you can get in touch with Josh in the states that we actually are licensed in, and get in touch with one of our advisors in another state if we're not licensed there, to really guide you through the process, answer your questions, help make sense of the confusion out there if there is any, and ultimately just, help you make the right decision for yourself. So if we could be of any interest, service to you, do us a favor and click that referral link. So Josh, you mentioned a moment ago numbers. 400,000. We're going to talk about buying it, March of 2023. So just over a year ago at a $400,000 purchase price at 7%. And we're going to talk about what that looks like with points. And let's dive into the numbers.
Absolutely. So that loan, $400,000 loan at 7% at that time, $2,661 a month principal and interest. And when we're talking about refinance, the principal and interest is the only thing that's going to move. Your taxes, your insurance is all going to stay the same. You might be able to lower your mortgage insurance, but that would have had a total payment of about $3,350. So at least here in California with 1.25% taxes. If you're in Texas with 2.5% taxes, obviously going to be higher. If you're in Florida and you got $250 a month insurance. So let's focus on the principal and interest, because that's what we're adjusting here with the refinance. So we're going to project and say, let's say some of these economists are correct. In June of 2025, you get an opportunity to lower your interest rate. And at that time, a 0-point interest rate is about 5.5%. You would have paid that $400,000 loan in those 2 years down to about $391,000. So that's where we're starting with. That's our loan. You have paid off almost $9,000 of your loan in a little more than 2 years, 25 months. Depending on where you're at and depending on what type of loan, if you don't need an appraisal, it could be lower than this. We could be anywhere from $1,500 to $5,000 in closing costs. For this example, we're saying closing costs for the refinance are $3,000, and we're saying prepaids are about $5,000. That's 30 days of interest, 6 months of property taxes, 6 months of homeowner's insurance. Depending on where you are, depending on what time of the year, those could be different, but reasonable numbers that are going to make the point of what we're going through.
And Josh, with that, I'm assuming no points, right? Because we said points at the beginning. So these are, when you're paying closing costs, you're just paying what? So
escrow, title, right. Appraisal,
so things you can't avoid.
Notary fees. Some areas have small taxes on refinances. All of that stuff. Anything other than points.
So if I'm going to lender A, lender B, in theory, all of those fees should be more or less the same. Is that right?
A skilled loan officer and that kid in the call center, not because he did it, but because whoever is running that call center, they have shopped, and we can get really low title, escrow, all of that. So most lenders should be pretty comparable and be able to keep these much lower than what you're used to seeing on a purchase transaction. That being said, you go to a loan officer who doesn't do very many refis and they don't know they can shop, and they just go, oh, my friend that closes all of our purchase escrows, I'm going to send this over to her. And it comes back, and I've seen one where the fees can be $1,000, $1,500, $200 or $2,000 higher than what they need to be because that person didn't know how to shop. But $3,000 is a reasonable estimate that most people should be able to hit. So let's go back to that first example. You called the Super Bowl ad, you talked, and they're like, you've heard rates are down at 5.5%, you're at 7%. You think it's a good time to refinance. They go, bro, I got you. I'm going to get you 5%. We're way better than that. I'm going to save you a ton of money. Again, they're probably not telling you, I'm charging you 2 points to get that. The market at 0 points is at 5.5. 2 points will get you down to about 5%. So with that, we just added, in this instance, another $8,000 almost in points. So we went 3,000 closing costs, 8,000. We got prepaids, $5,000. They don't want you coming in with any money. They're telling you, hey, skip the payment. You're going to get a refund of your impound account. By the time we're done with that, your new loan is $407,000. So you went from 391 to 407. That's the bad news. And they're not going to tell you about the bad news. They're going to hope you don't notice that part, because they're going to go, awesome, bro. 7% to 5%, $475 a month, $6,000 a year more. Dude, for you and your family to have to spend, Jeb.
Where do I sign up?
Where do I sign up?
I mean, this is great.
That's how the pitch goes. Only better. I mean, some of these people, they're not skilled loan officers in terms of the financial aspect of this, but they're skilled at talking to people on the phone and presenting the numbers in a way that you're like, hey, I'm in. Let's do it. Well, let's look at what that 5.5% loan looks like with 0 points. So now you only have a $399,000 loan, and the payment's $22.66. So you're only saving $394. $80 worse a month, but you have $8,000 more equity in your home. Almost every time that I present numbers to this, 9 times out of 10, the people will say, oh yeah, I'd rather have $8,000 of equity in my home than save $80 a month. Because remember, the difference, that $80 is in interest. Most people, consult a tax advisor, are going to be able to deduct that. So really, if you're at a 25, 35% tax bracket, it's a $50 difference in the monthly payment. But you have additional equity in your home. Now let's look at that same option and we say, well, you're 25 months into this. Let's do that 335 month term. So we have the same loan amount, $399 and change, and the new payment is now $23.34. You're only saving $326 a month. So we went from $475 to $326, but you have $8,000 more equity, and you didn't just waste 25 months of $2,600 a month payments. I mean, that's $10,000 every 4 months. We got $6,000, $7,000 poof out the window that we're never getting back unless you're in that loan for a really long period of time. Now, I always, in this instance, want to throw out another option to someone here. Let's say that $3,000 of closing costs, if we go up, and I use an extreme example, I went up 0.25% in interest here, that would get us more than enough to cover all of the closing costs. So you got no closing costs. I structured this here with you bringing in that missing payment. So I just had this with a listener to the show. We got them locked back like in March before rates kind of popped back up. They closed last October at 7 3/8. We were able to do it 6.875, no costs, covered all their costs, but he brought in $10,000 at closing. And you're like, that's crazy. What is that? It was almost exactly one payment and the balance that he has in his impound account. So he knows on June 1, he's not going to make a payment. And he knows somewhere mid-June, he's going to get a check for that impound account. So in 30 days, his checking account is going to look the same, but we didn't add one nickel to his loan balance. So this is the example here. So same thing, say 5.75. We keep the loan amount at $391,203. We keep the same loan term, and now that drops the payment to $23.47. So $313 savings a month, but you didn't do anything different. We have the same repayment length of term to get it paid off. We got a lower interest rate. We got the same loan balance, and you didn't really skip any payments. We didn't put any extra money in your pocket, but every year going forward, $3,600 additional dollars in your pocket. So Jeb, to put a bow on that, it's easy to say, well, that's what it is today. Let's look forward all of those over 60 months and see how those differences play out and kind of what you should be thinking of. That option that we said is terrible, paying 2 points, maximizing out your loan amount, you still in 5 years owe $374,000, but your payments, the lowest payments there, were only $131,000 over that time. If we do it 0 points, you owe $369,000, $4,000 less, but you paid $136,000 over that time frame. So you actually paid, $5,000 more and you have $4,000 more equity. So if you know you're going to be there for 60 months and there's not going to be another opportunity to refinance or to get that 5% at 0 points, over time, this can be justifiable. Same thing, we go to 0 points in the same loan term because we're shortening the repayment term, $365,000 that you would owe. So you're $8,000 ahead of the game. You paid $9,000 more in monthly payments over that time frame. And then the last one is probably the one that I like the most. Your loan balance is all the way down at $358, and you paid that same $140 because you're paying interest on a smaller loan. So long way of saying there's not a right answer. No one, if I show 100 people, all 4 of these, there's going to be a chunk of people, a group of people that will be drawn to each one of those. But if you don't have a lender penciling this all out, showing you what that money is, where it goes, and helping you kind of go through your plan, your future, your path, and figuring out which is the best option for you.
No, and I think that's the important piece is that, the topic of mortgage, the topic of real estate, it's confusing. There's a lot of jargon. There's a lot of just different things. And the more people you talk to, the more confusing it can get because it just is what it is. And so make sure whoever you're working with is somebody that you trust, you have confidence in them, they have experience. I mean, one thing you can do is look up somebody's NMLS number, right? It's like their license number. Real estate agents have a DRE number. Do the same thing for real estate. I mean, mortgage, you can go type in their number and you can see their experience. You can see where they were working a year ago, 6 months. 6 years ago, 15, 20 years ago. You can see their work history. This is important. Guys, if somebody just got their NMLS license a month ago because there's a refi boom, probably not the person you want handling your mortgage. Go to somebody that has the experience. Sounds self-serving, but I can tell you at the end of the day, we get calls every single week from people that have blown up deals, their deals getting blown up rather, can't close because they were told something, just horror stories. Prevent it, guys. You have the control to make the right decision. You just have to do it. So if we could be of service to you, do us a favor and click that referral link. So Josh, if you had to sum all of this up, I just kind of summed it up, but how would you wrap all of this up in a couple short sentences?
Get with an advisor who can ask you good questions that lead you to a path that you think you are on, clarifying your goals and objectives, and then giving you options to meet those objectives and walk you through the pros and the cons so that you can make the right decision. On top of that, Jeb, we talked about this is more for rate and term refinances. It really does apply equally to cash out. It's just on a cash out, we have people that are giving up 4% interest rates for a 7% interest rate because they have so much debt or an opportunity to invest. There's something out there that getting that money is more important. But all of these things apply to how you can structure a cash out loan to keep the loan size minimized and optimize the repayment. So big picture, get with an advisor that knows how this stuff works, that knows where the money is going, and can most importantly help guide you to the right answer versus telling you the right answer. Because there's not a right answer. There's a right answer for you, and only you are going to know it.
Yeah. And with that, what I'll say is there's a lot of people equally as good as Josh and myself at this business. A lot of people. But there's equally as many and more that aren't as good. So take the time, do your due diligence, get off Google, get a referral, start with the link below, and let us guide you through the process. Until next time, guys, buy right, borrow smart, build wealth. Adios.
Amigos.